Hey everyone, my name is Gilles. I've been investing and trading for almost 30 years, and most of the recap videos I make are for my mentees inside WhiteSands Trading and Mentoring. But moving forward, I want to share more of what I teach publicly, especially for beginners who want to learn what real disciplined trading actually looks like. Most beginner retail traders judge themselves trade by trade, but real consistency only shows up over sets of trades, not individual ones. So I'm launching a new 25 trade Douglas Journal series to show you exactly how real trading edge performs over time. By the way, the idea of tracking trades in sets of 20 to 25 trades comes from Mark Douglas, the author of Trading in the Zone. He teaches that traders' edge only revealed itself through a proper sample size, never through individual trades. In this series, I'll be trading stocks only using my core list of 10 tickers that I focus on every day. But I want to be clear, the principles I'm using, fixed risk, structured setups, sample sizes, they work in any market. Forex, crypto, futures, whatever you trade. I'm keeping the risk at just $10 a trade so beginners can follow along. You don't need a big account to learn to trade properly. You need a fixed risk, you need a repeatable process, and an edge. And this slide proves it. Now, even though it uses a $100 risk example, the math doesn't change. With proper risk reward, even a 50% win rate can be highly profitable, and beginners need to see that visually. Before we go further, I want to explain why this entire series is done in sets of 25 trades. It comes from a principle called the law of large numbers. It simply means this: the more times you repeat the same process under the same conditions, the closer your results get to true probability. Think of flipping a coin. If you flip it 3 times, anything can happen. You might get all heads. Flip it 10 times, still random. But once you get to 25, 50, 100 flips, things start stabilizing. They start reflecting the true odds. Trading works the exact same way. A sample of 25 trades is not massive, but it's big enough for beginners to start seeing the pattern. And when you stop caring about the results of any single trade, trading becomes far more consistent. That's why I'm tracking this journey in 25 trade sets. Same risk, same rules, same edge. We're not judging one trade, we're judging the process. And before we start, I also want to be clear about what I'm actually trading. I use a very structured playbook built on 3 core setups, each with a long and a short version. That gives me 6 trades total. That's it. Each one can win or lose, which gives me really 12 different possible outcomes in this series. These are the only trades I take. No guessing, no gambling, no I had a feeling. Just structured setups executed the same way every single time. So for this entire series, I'm only sharing 2 possible outcomes, -1R or +3R. Now, if you're new to trading, let me quickly explain what R means. R simply stands for risk per trade. It's a unit of measurement, the amount you're willing to lose if the trade fails, and they will. So in this series, 1R equals $10. A losing trade is -1R, meaning I lose $10. A winning trade is +3R, meaning I make $30. Using R instead of dollar amounts keeps the math clean. It removes emotion. It shows beginners exactly how consistent risk management creates an edge. So over the next 25 trades, you're going to see exactly how a real edge behaves. Not only one trade, not over 3 trades, but across a proper sample size that starts revealing the true probabilities. If this series helps you, feel free to like, subscribe, share it with someone who needs it. If you have questions, drop them in the comments. I'll do my best to answer every single one. And if there are any terms or acronyms you're unsure about, check out the trading glossary from my website. The link is in the description. And don't forget, what one person can do, another can do. Just trust the process.